Well, let's get across the market open now with Kyle Ryder from Capital.com. Kyle, happy Monday to you. Let's start on in the States Friday. Got the key read there on jobs with the non-farm payrolls. What was the reaction to that?
Yeah, fairly muted reaction overall. I mean, there was some fairly significant concern of, sort of an asymmetric and downside risk going into the data just because of the uncertainty about the impact of sort of Doge cuts and the cuts on public sector jobs and how that may manifest in the data. At the end of the day, we saw 151,000 jobs added to the economy. The unemployment rate ticked up to 4.1%. Obviously, the rate of jobs growth wasn't great enough, and the participation rate unexpectedly held steady. But just still questions now as to what extent the really disruptive measures by Doge and obviously the Trump administration, what that will have on employment going forward. And there are already sort of indications within the data that that's starting to have an effect. The private sector added the lion's share of jobs for the month, and Treasury Secretary Scott Bessent sort of lauded the data as an example of the private sector doing the heavy lifting when it comes to job creation, and that the public sector was kind of lagging to some extent, or certainly seeing the rate of jobs growth decreasing, which rightly or wrongly seems to be a sort of fairly key policy platform for the Trump administration to really change the balance of jobs creation in the economy back towards the private sector. The real concern now is that the survey period probably didn't capture the full extent of job losses that will probably come in the next month's data. And there's also concern too that because we might be seeing a bit of a pullback in public spending, that of course aggregate incomes are going to drop because of the job losses that have already been sustained, that we'll start to see a greater degree of weakness coming through the the non-farm payroll figures going forward, and that may manifest eventually in a much weaker economy, an economy that will require interest rate cuts sort of sooner rather than later. And the markets are pricing that in now, not just because of the jobs figures that we got on Friday night, but also the weak manufacturing PMI numbers. The services PMI was okay, but certainly showed signs that maybe employment was at risk of contracting or at least slowing down fairly soon. And there's all these indicators again that the US economy might be heading for a period of softness. The word recession is getting thrown around, but of course that's a little bit premature. So again, the data was solid on the surface, starting to show those sort of cracks perhaps in the labour market, but one expects that the next the next couple of months of labour market figures will be really the kind of barometer to what extent the Trump administration is really kind of having a significant sort of deleterious impact on labour market conditions.
Yeah, Kyle, those job cuts combined with continued uncertainty in regards to trade policy, certainly unnerving markets and investors at the moment.
Yeah, and if you listen to President Trump's rhetoric, confidence keeps coming up as a word that he likes to use. And that was in response to the fact that we've had a couple of consumer sentiment readings that were fairly poor. We've had some data suggesting that consumer spending is also being pulled back on the basis of concern about the outlook for the US economy. And if you do look at the ISM surveys last week, there was a lot of talk about pulling back on investment and employment until there's greater certainty, policy uncertainty coming out of the United States. The Trump administration, rather than reacting to this in a way of trying to, by sort of pulling back on some of the more aggressive trade and other policy measures, have sort of taken the stance now of kind of this is short-term pain for long-term gain. The economy has to take its medicines so that we can achieve our long-term goals. And while that might have merit depending on your sort of ideological position, for the short term and for market participants, that does indicate that the Trump administration is more concerned about these structural shifts related to some of the more radical elements of their sort of policy regime than potentially keeping the economy on an even keel. So this does raise those questions again about whether there needs to be earnings downgrades coming through for equity markets, whether there is a degree of policy easing that is to come sooner rather than later, and it certainly does rest on the fact that there are these concerns that even if the economy does slow down, inflation isn't at a level yet where the Fed will be sort of there to kind of radically ease monetary policy to support the economy. So it's giving these sort of mixture of concerns of sort of a stagflation-light scenario, which again is a word that's been thrown around prematurely, but certainly not unjustifiably. So really, there are these concerns now about US economic growth. That's perhaps that period of US exceptionalism and outperformance, at least compared to the rest of the world, is starting to diminish. That sort of convergence is emerging, and it's sort of no surprise that given some of the developments that we're seeing in Europe in terms of fiscal spend, and in China as well, with sort of policy settings, as well as a sort of reflation of asset values because of this emergence of the AI trade in China, that money's maybe coming out of the United States, and sort of rebalancing, or there's a repositioning, I should say, going on into other areas of the global equity markets, away from what was a very expensive US stock market. So again, certainly those concerns there about the growth outlook going forward, and where investors should be allocating capital in order to basically take advantage of these sort of changing economic fundamentals and this convergence potentially in economic performance.
Yeah, well, we get a inflation read out of the States midweek. We've also just had the latest inflation read out of China, which is showing some weakness there.
Yeah, really disappointing, and unexpectedly large drop. There were some base effects at play, it has to be said, but the number was worse than expected. And critically, we saw the core CPI element actually drop into negative territory, so it was down by about 0.1%, which it hasn't done for quite some time. We did see that prolonged period last year of headline inflation, or deflation, I should say. That happened once again. It was sort of a rate of negative 0.7%, but the core CPI figure had more or less remained kind of in positive territory, albeit in the very low single digits. It does raise questions about whether this kind of recovery, that in part the bounce in Chinese assets and some strength that we have seen in the Aussie dollar recently, certainly pulling itself off its lows, whether that's maybe premature, maybe there is still persistent risks related to China's sluggish economy, and that again these kind of drivers that have weakened fundamentals are still persistent. Mostly, the excess leverage on private balance sheets that is kind of crimping consumption, and that any kind of recovery is going to still be slow and painful. And this kind of trajectory we've seen for stocks in, well, particularly Hong Kong, but to a lesser extent, mainland equities as well, might have been a little bit premature, maybe a little bit of an overshooting there. A lot of optimism sort of being baked in simply because of the artificial intelligence trade, or the kind of catch-up trade with Chinese tech, but the sort of fundamentals and the earnings outlook aren't necessarily matching that enthusiasm just yet. So a really sort of disappointing print still shows that China's economy is in a period of malaise, and perhaps those structural challenges that the policymakers are trying to address. Announced those suite of measures last week at the National People's Congress to try and sort of tackle as well as stimulate private demand, especially amongst households. That it's going to be very, very difficult to achieve that, given the overhang of these significant problems that are either keeping confidence very low in China, or basically financial conditions incredibly tight, certainly at least when it comes to households.